Welcome everyone, welcome. Thank you very much for joining me. My name is Adam Harris and I will be your speaker presenter. I'm trying to drop my seat. It's not going to happen. I will be your speaker and presenter for this evening. And again, thank you very much for joining me. So first thing I want to do, just make sure, yeah, there we go. You can see me okay. So welcome. This is one of I think this is the second webinar that we've done, and I'm always very excited to do it. I wish we could do them more often. If it was up to me, we'd be doing them every week or every 2 weeks at the very least. So first thing I want to do is make sure we're being recorded so that we have a copy of the recording, which it is. That's all good. And also then make sure that the sound is good. So my microphone is over here. You should be able to hear me and see me. So that should all be good. Then you should be able to see the screen, and the screen is the slide that says price action trading techniques, and obviously my name, Adam Harris. So today is special because, well, this month is also special because it's because it's 2023 and it's November, which is the 11th month of the year. So if you put it together the way the Americans do, it's 1123 or 1123, which is international Fibonacci. That's a Fibonacci sequence. So today we decided to do the topic of Fibonacci. How do we use Fibonacci in the markets? And what is the relevance? And it's really meant to be a lot more. It's meant to be about having a bit of fun. And what I'd like to do is talk a little bit about Fibonacci in the markets as a tool, a little bit of the history behind it, and then also go and have a look at the charts. Now, we would do a series of these types of webinars going forward. So today we'll cover a bit of Fibonacci and maybe a little bit of price action as we go and have a look at the markets and see how they're doing and where the potential trading opportunities are. So I think we can just kick off a little bit here. So first of all, Fibonacci, Leonardo of Pisa, Leonardo da Fibonacci is almost 1,000 years old, so going back just 900 odd years old. And he brought the sequence to the limelight in Europe, previously described in Indian mathematics. So he was a famous mathematician, not related at all to Leonardo da Vinci. And so he observed there were these natural patterns, leaf arrangements, the way that trees branch, the way that shells spiral, it's everything. The way that snowflakes and the way that they branch out, the proportions of our limbs, the fact that our ears tend to be straight over our nipples and that our eyes and ears tend to be parallel, all these different relationships basically to do with proportions that we find everywhere. And it's so prevalent. It's right in our DNA. It's in the way we're physically built. It's in the spirals, in the galaxies, in space, in the universe. It's everywhere. It's absolutely incredible. Once you become aware of it, it becomes very difficult to to pretend that it doesn't exist. So the Fibonacci sequence was introduced, obviously, as we say here, while the sequence had been previously described in Indian mathematics, Fibonacci's work brought it into the limelight in Europe, and the sequence has been observed in natural patterns such as the arrangement, the ways in which leaves grow, the branching of trees, the spiral of shells, it's just everywhere in the way that things move as well. And the application of Fibonacci in trading can be traced back to the 20th century. Analysts and traders discovered that Fibonacci proportions, I'm not going to use the word ratios, but proportions appear in financial markets, the breathing out and the breathing in as buyers and sellers get out of the markets tends to find that we repeatedly tend to form or create these types of proportionate moves in the markets. And these ratios could then be used to predict areas of support or resistance in price charts. Okay, so what does that mean? Well, let me describe it a slightly different way. So what I'm going to do here, deviate a little bit from it and just talk a bit about it while I use my draw tools. I just want to get rid of this menu. There we go. So I've got more space and quickly choose my color. So for example, before charts even existed, so if you go back 100 years ago, 200 years ago, before we had computers in the 60s and 70s, which is more like 40, 50 years ago, it was always about price. So traders would collect at the exchange, and as the price updated, they would write it up on a board or they'd have it on a ticker symbol. And so the market has always been about price. And this has become incredibly noticeable when we look at a commodity such as gold, where we can see that the market has this particular prices that might be significant. So you might, for example, have $900 for gold, which is significant. Then you might find that the market also perhaps responds at $950. And then for sure that the market will respond at $1,000. So this is just price. This is just numbers, round numbers, and the market tends to respond to that. But in addition to that, we then found that also while the market is moving, it tends to have certain types of behaviors. It'll do a move and or what we call an impulse or retracement, or an extension and a retracement. And then it might find that it's bumping its head up here, and then maybe there's a breakout and then a retest, and then it might continue on. And so we get these types of responses that the market does, the price action itself does around these particular levels, but also in the way in which it moves, the relationship between the extension and then the relationship, the retracement. So that if the retracement comes back halfway, we would typically, and we're going to go and have a look at the particular numbers now, but we might call that a 50% retracement. So in other words, it's gone a move, and as it comes back, it goes back 25%, 30%, 40%, 50%, 60%, so on, all the way back to 100%. So what often happened was that the traders observed that we often have repeatable types of proportionate moves, the distance against the previous move, this distance in relationship to the previous move. Okay, so that being said, let's go back to the slides. Okay, so what's fascinating about it is that it actually makes sense. We have these proportions almost everywhere that we observe it. It kind of makes sense that we would also behave in certain ways. So for example, excuse me, very thirsty, and because I've been talking a lot today. But also if we walk somewhere, for example, we tend to know, okay, well, this is a halfway point, or we've gone a certain distance. And so there's just ways in which we almost automatically break distances down into smaller proportions, but often it's unconscious as well. And so there were certain numbers that tended to show up a lot in the in terms of Fibonacci ratios. And also I just want to talk to you a little bit about the Fibonacci sequence, because we spoke about it being International sort of Fibonacci Day, right? So if we're going to have a look at this and we talk about a Fibonacci sequence, and I believe the origin of this came from a discussion where he was at dinner and a friend asked him to calculate how quickly 2 rabbits could reproduce on an island. So he said, okay, well, first of all, you would have no rabbits. So we just make this a little bit bigger. You would have no rabbits. And then if you added 1 rabbit, you would have another rabbit. You'd have 1 rabbit, right? And then if these 2 rabbits reproduced, you would then have 2 rabbits, okay? So I beg your pardon, so you would have no rabbits, then 1 rabbit, then you added a rabbit, and then you would have 2 rabbits. And then if these 2 reproduced with this one, you would end up with 3. So you then are adding the previous number to it. And so this is where Fibonacci month or Fibonacci day comes from, which is 1123, which is essentially November 2023. Then we keep going. The sequence goes. We get 2 and 3 gives us 5. 5 and 3 gives us 13, or 5 and 8 gives us 13, I beg your pardon. There we go. And it continues up from that. Where it gets really interesting is when we start doing a little bit of math. There are proportions between these numbers. So for example, if I take, let's just say I'm going to take the 2 and divide it by the 3, just for fun. So 2 divided by 3 gives me 0.66. Then I'm going to take the 3 divided by 5. I'll take the 5 divided by the 8, or the 8 divided by the 13. Just try that. Just basically do that. So let's take 8 divided by 13. We get 0.615. It's very similar. Let's take 5 and divide it by 8. And we get 0.62. And let's take 3 and divide it by 5. I think I did that one. And we get 0.6. So it's usually a 0.666 something, or a ratio, a version of that. Now we're going to go the other way. So now we're going to take the 8 and divide it by 5. We'll take the 5 and divide it by 3. So we're going to go in the other direction. All right. So let's start with 13 divided by 8. We get 1.625. Then let's try again. Let's go 8 and divide that by 5. We get 1.6. 5 divided by 3. We get 1.666. And let's go 3 divided by 2. And we get 1.5, and so on. So the point is we tend to be very close to 0.6 going the one way and 1.6 going the other way. And these are Fibonacci ratios and Fibonacci numbers, okay? And this is a Fibonacci sequence. So we want to talk a little bit about them as percentages as well. And we've got the key ratios. These are the ones that are generally used as default settings when we place them on the chart. So before I take you through these, I want to demonstrate them to you on an actual platform. So let's go to the platform. And let's create a brand new chart over here. And in fact, let's just simplify it. Let's go and just create it as just as a default. Let's remove all the different indicators so that we're just dealing purely with price. Get rid of the moving averages. And then I'm just going to save this as candles only. So I have that as a default template. All right. And so I'm not going to worry about it too much, but let's bring up the Fibonacci retracement and I'm going to measure it, because today what I would definitely like to do is to show you how we go about measuring that. And so usually we're going to do it because what I want to do is to calculate that proportion, that move up and the relationship, and the move up and the relationship. So I'm usually going to measure that to see where we are. And again, on the way down, we will measure from here to here once it starts moving up so that we can determine where we are. All right, so let me just see, there's a question that's come in. Do I speak Portuguese? No, I'm afraid I don't. I'm afraid I don't. So I apologize for that. So what I was going to say here is, once we just place this on, you'll see there's actually default numbers that have been created in here. We've actually got the default levels. We've got 23.6, 38.2, 50, which is strictly speaking not actually a Fibonacci number, but it is a midway point. It's a natural resting point. We've also got 618. So let's just go back across to the slide so we can see these different numbers here. 618, 100%, for example. And these are then the basis for retracement and extension levels. So let's just very quickly recap where we are. We use Fibonacci measurements to help us identify potential entry points around where the market is pulling back to, which could also then line up with support and resistance. And we can use Fibonacci extension measurements to identify potential targets once we've entered that trade. So today, Fibonacci retracements and extension tools are just standard in pretty much every trading software or platform, and traders across various financial markets use these tools to identify potential reversal points, set target prices, and place stop loss orders. Whether or not we believe in them isn't really so important. There's very much a case of cause and effect. There are lots of traders who love to use them and consider them incredibly reliable. And because of that, there are orders that are placed in the market and it becomes cause and effect. It becomes a self-fulfilling prophecy. So are Fibonacci retracement levels reliable? Yes, they are. Are they popular? Absolutely. And so we tend to use them because other traders use them. So how would we include these into our strategy? Well, first of all, what we want to do is talk very quickly about how we would use them in the chart. They're most powerful when we use them in a trending market, I beg your pardon. So if I just go across to my document here, and for example, we could see that the market is trending. So let's just say that we have a trend that's heading higher and higher and higher, and we see the market has started to turn around. What we want to do ideally is identify where the market might potentially retrace to, where there may be a possibility or a level where we could identify a possible entry point so that we could join it in its next leg to the upside. So what we want to do is learn to identify particular areas. And that's just one aspect of it. That's just one step that we need to take. We need to also then wait for the market's reaction at those levels. So usually what we would do is we'd measure from this previous low to this one as it starts to move so that we can identify these key levels. What advanced traders or more experienced traders often tend to do is they will measure from other lows as well to see if there are any additional Fibonacci levels that overlap. And when they overlap really closely, we call that a cluster. And that means usually that there are traders on different time frames that would then be placing their orders in those particular areas. So when the market is heading higher, when the market is trending higher, there are usually buy orders trailing behind price. Now, at first that might not make much sense, but I want you to think about it like this. I'll give you two examples. So let's just say that there's a house I always want to buy, but it's very expensive. So and I have a bit of spare cash, but I'm refusing to pay the price that I think it's overvalued at the moment. Maybe I feel that we're in a property bubble. And so I have an order waiting maybe with a real estate agent or with the owners, so that if the market ever does drop, or should that property ever come on the market at a particular price, I would make an offer at that particular price. So what that means is that even though the market is up here, my expectation is that if it ever does come down here, I want to buy at that level because I want to buy it at a discount. So that's one example. The next example is if there's a stock. So let's say you take a blue chip stock such as Microsoft or Berkshire Hathaway or Coca-Cola or Intuit, any of those. Nvidia would be a blue chip stock as well. Google, Alphabet, you took those. Often what happens is incredibly wealthy people, as well as the average individual who is looking to buy, will usually have orders waiting at lower levels below price. The idea being that if there's ever a nice drop in the market, or you get a bear market or a really nice correction, you have an opportunity to buy that beautiful, expensive blue chip stock at a cheaper price. And once it goes up. So the whole idea is that generally as price is trending higher, we have buy orders that are just trailing behind it. So why does that matter for what we're doing today? Well, it means that if we are in an uptrend and prices started to retrace, we want to ideally be able to find an area where there are lots of buy orders, which would be close to or at Fibonacci levels, as well as other levels, as well as support resistance levels, as well as at round numbers, potentially also at pivot points. And so we're looking to see, that implies there would be a cluster of buy orders at those levels. If the trend is nice and strong, there are more likely to be lots of buy orders at a particular level. And so we would be looking to identify that area because that's where we would expect the market to have a reaction. We would expect price action to have a reaction in that area. And the same goes for on the way down. So if a market is trending lower, generally speaking, there are sell orders above it. People who might be going, I'm on the wrong side of this, so if the price does come back up, I want to get out. So they look to exit that. And other people who are obviously looking to add to their short position and potentially they're shorting the markets. So we tend to have a lot of sell orders as price is going down. Right. When the trend starts to come to an end and starts turning around, then you'll find that the sell orders will evaporate and start being replaced by buy orders following it up. Okay. But also every time we get into the market, somebody else gets out. So these buyers and sellers are getting in and out of the market at all times. And if you think, let's just say we're in a bull market, as price is heading higher, why would there be sellers in this point? Well, first of all, there's lots of people that now have the money they've always wanted to make, so they decide to sell. Maybe, for example, they've owned their house for 20 years and now they want to move or they want to retire. They want to sell their house. So it's, even though the property market is bullish, they want to sell their house and get out. Vice versa, when the market is going down, and obviously here when the market's going up, people are buying because they're worried that if they don't buy now, they're going to miss, the market prices are going to keep going up, and then they won't be able to afford to buy in the future. So there are buyers and sellers at the same time. On the way down, you will have people who are buying on the way down because it's getting cheaper. So they definitely want to buy now because it's more in their price range, or their dream house has become available, or they have the spare cash, they can use it for investment purposes. And at the same time, you have people who are selling on the way down because either they are panicking, they wanted to sell their property anyway, but now the property prices are dropping, so they better sell now, or possibly they're starting to panic. So buyers and sellers always in both types of markets. It's not always obvious. Some people don't realize that when they decide to take action, that they're going to be on the wrong side of the market conditions. Okay, so we know this because there are just so many different types of market participants. So when we're doing this, one of the things we like to do is to identify areas where price can come back to. And this is a great example. This is the first one I put up, but measured from here to here, and you can see how crisply the market has responded to the 382 fib level. So we often just call it the 382 or a 38.2%, but 382 is fine. So 382 fib, 50 fib, 618 fib, for example. So one thing that I would add here is that when we have a very healthy trend, the furthest a strong, healthy trend will retrace is the 618 on average. So generally speaking, you can have a very nice pullback to the 618 and keep going. Most of the time, if we go beyond that, if we go further than that, the trend is not that strong, and therefore it's likely to fail. So because of that, professional traders will tend to focus on this area for a potential move to the upside. We won't look beyond that. This area here between the 618 and the 382 is the sweet spot. All right, that is the buy zone in an uptrend or a sell zone in the downtrend. We are looking for reversal points at any one of those three places. You can see again here, you can see that if we just draw a line across this, you can see that there are similar reactions at those levels, fib levels as well, 382. So it makes sense because all the moves kind of tend to happen within each other. Even here, if you take the 236, it's not precise. You can see it's more or less in that area. So how would we know which one it's going to be? Well, we'll talk about that in a moment, but let's also try something different here. Let's add a second one in. So I'm going to go from the bottom here, for example, and I'm going to measure up to there, to the same one. Okay, so I'm going to measure it up to the same one there. And all I want to do here is to see if there's any overlap. And what you will see, for example, when I measure from the low to the high, is this area, the 50 fib and the 382 tend to overlap, and we would refer to that as a cluster. And it's very nice because you can see how closely they are related to each other. This isn't terrible, but it's not as good as that. So what does that mean? Well, it means that if we didn't know what was going to happen, if we didn't know what was going to happen on the right side of that line, then it wouldn't be unreasonable for us to think that the price might be coming back to this level, or potentially that level, but probably this level, before turning around. That would have been the most logical way to respond to that. As it happened, it responded to the 382 very, very precisely. But not just the 382, ladies and gentlemen. It responded to the previous high, the most recent support and resistance. That is resistance, that's resistance, that's resistance, and it found support there. So that's a very logical, normal behavior for the market to do. It was an uptrend, then it was in an uptrend, it broke through resistance and came back and retested it. The first potential sign that it was possibly going to turn around would have been this candle here. But then the next candle didn't go anywhere. So in other words, we would have expected it to potentially go up after that, but it didn't. The next candle was here, but then it didn't go any lower. Instead, it produced another green candle. So we look for this. When price breaks through and comes back and does that, in this area, we look for bullish candles because we want a red candle and then a green candle and then a green candle as it produces that swing low. And so we got this, and then the next candle was our higher low, and there we get that rejection of the level. But there was a whole lot of it together. You can see here's your first, well, actually, if you want to be really critical, we have a beautiful wick here, then we get a green candle with a wick, and then it looks a bit like it's not going to happen, but then it doesn't break below that low, and then we get a green candle there, and then it takes off, and then it takes off. And so actually these would have been really good potential setups for to take. They might have taken this one, and it might even have been a losing trade. So they would have put their entry above the high and been triggered in, and their stop loss below the low and been stopped out, and then the market would have gone. So it wasn't that the idea wasn't valid. The idea was a great idea. It was a perfect trade idea. It just would have been a false start, and that often happens. With me, I'm right about the direction of the market a lot, but I often have trade setups where I get a really nice candle, I get triggered in, stopped out, then the market takes off. So it's not the direction that's as hard to predict as it is that identifying that exact entry candle. All right, so let's play with this a little bit more. Let's have a look at a few other things here. So we'll get rid of that. and let's play with it a bit more. So kind of bring it up to where we are now. You can see it's sort of pulling back into the 236. Most of the time, most experienced traders worry about this one too much. We'll take it out. It's not that it isn't valid, it's that it tends to be very useful, more useful in very strong trends, but for your average day-to-day bread and butter earning for trading, you want to simplify your workload. So you tend to want to focus on the three levels where the turning around point, that buy zone, is most likely going to happen. So what does it mean? It means that price is most likely to respond to that level, or probably that level, or maybe this one. And what you will do is observe how price responds when it gets to that area. And could it do something like this? Could it sort of come down here and then try and then sort of fail and then get there and then go? Yes, it could. It could do that. So you could end up having, you say, look, when this, let's just say this was euro dollar, you go when euro dollar comes back to this level or any of these levels, you see it produce a nice bullish setup, you say that's great, so I'm going to take it. You get triggered in, stopped out, you think, oh, okay, I'm wrong, gets in here and produces a beautiful bullish double bottom, and then it takes off. So it's really anywhere in this area where we start to look to see how the market is going to respond to that. Okay, and if we go back and bring this up here, we can see that here it's coming into the 382, potentially the 50 fib and the 618 as well. And it's beautiful when these things overlap with support and resistance numbers. So let's forget about this one. Let's go look at something different. So let's go and have a look at gold. Okay, or silver, it doesn't matter. Excuse me. So it's most powerful when we use these measurements in a trend. What we really want to do is use them in a trend. Using Fibonacci in ranges is really tricky, because in a trend what we're trying to do is to use them to identify entry points, and that's where it's at its most reliable and it's most effective. When it's in a range, the market isn't really going anywhere, and using Fibonacci becomes messy and a bit frustrating and doesn't necessarily lead to high probability trade setups. So just go back to the slide deck and just see where we are at this point. So our goal here is to find a trending market and then use Fibonacci levels or use the Fibonacci measurement tool to help us identify areas where price is likely to come back to provide us with an entry point. It'll come back to a previous high or potentially even to a trend line. And actually, as those things happen, we get more and more evidence that this is a potential setup. I'm just trying to think. There was a chart I was looking at earlier where we could do this, and maybe we'll go to a 1 minute and have a look at that as well. How are we doing for time? Are we good? Yeah, we're good for time. So absolutely, trend confirmation as well. It helps us identify entry points and sell points, and of course entry and exit points in terms of taking profit. We can use these with other indicators, so it's an interesting place to be as a trader. And this is one of the biggest tips that I can give newer traders, is that success in trading comes from doing the basic things really well. The basic things really well. And those basic things are learning to identify support resistance, learning to identify a trending market or a sideways market. So in other words, knowing whether you should be buying or selling or staying away from the market. Making sure that if you're trading versus investing, you're taking profit, making sure that you use the stop loss, making sure that you are consistent in your behaviors so that you are not, to me or you, so that we are not the random thing that keeps changing our results, making sure we don't change strategies. So we want to be consistent ultimately. To get consistent results, we have to be consistent in our approach. So, and part of that actually is that fewer indicators is better for us. It's better for our brain, it's better for our confidence, and it's better for our results. And so if you said to me, well, Adam, what do you mean by fewer indicators? What does that mean? Give me, how many do I need? 2, 3, whatever. And are you including Fibonacci as an indicator, but a moving average and a MACD and an RSI? What's an indicator? So let's start with that. Let's go to a chart and let's build this from scratch. So actually what I'll do here is, again, I want to pick something that we can kind of analyze that's going to be moving. Let's try cryptos. Let's do that. Let's go to the 1 minute and let's have a look at this. Okay, So a market can only exist in one of two states at any one time. Okay, it can only be in any one of two states, only one of two states at any one time. It is either not trending, which is to say it's not moving, or it's moving. So it's either moving up, trending up, or it's moving down, trending down. Okay, so it can only be in one of those two states. And also then if you said to me, Adam, okay, so if I start with a blank chart, what is the most important information that I need to have on that? So if you build it up, and actually just in answer to that question, I'm going to quickly bring on gold because it's an old commodity that we have had for obviously thousands of years, but let's bring it up as a trader. And again, let me just change this to just candles, and let's do it this way. So if we're going to have a look at this from a very long period of time, okay, it's fine, we'll do it on a weekly basis. When we look at gold, all right, we notice that it has these responses to particular prices. So I'm just going to put in, say, 1800 there. I'll go here and I'll do 1900. I'm going to do 1700, just roughly go in and put these in. Doesn't have to be precise for the purposes of this, and then down towards 1600. And so what we notice is that with gold, for example, we often tend to respond a lot to round numbers, and it actually makes sense because as human beings that have been dealing with gold for centuries, we go, okay, it's worth $100 an ounce, $110 an ounce, 120, then it's 300, then it's 900, that's 1,000. So we have these round numbers that we tend to do that, and fundamental analysts are also buying and selling and making decisions on the numbers. They're not even looking at the chart, they're just looking at the numbers. And so we often find that price levels for any particular instrument is really the starting point. Once you put a brand new instrument on the chart, what you first want to do is identify the key price levels that matter to that instrument. So if we go back to Bitcoin and we go back to a weekly here, we can see this price level matters to this instrument right now. You can see it, especially when price connects with it from underneath as it does from above. And we can see how these levels, these matter. Sometimes it's nice to round it, to put it to close to a round number. So you could say, well, this says 30,557. And you could say, yep, clearly it's close to 30,000. If we zoom out and we have a look at it, all of its history, you're going to find 30,000 again down to 25,000. You could argue that that's the number. And then again, you could say 20,000. You don't have to go to the round number, but generally it'll be close to a round number. In this case, I would say that this is a really nice one right now. The one that I had, sorry, this one here, right now, that's 30,500. That's quite significant. And here, this one is 25,240, which is quite important to it at the moment. It's very crisp, and that's the kind of that's what we want to know. So this so price levels and then price action. And what is price action? Price action isn't just a single candlestick. It's not just that. It is that, but it's not just that. It is the sequence of candlesticks. It is the reaction of candlesticks at a particular price level. It is the entire behavior of candlesticks. There's my uptrend, but there's a reaction at this level. There's a reaction at this level. There's a big candle here. It is everything from the individual to the collective story that's being told. That is price action. Once we have identified the levels, ladies and gentlemen, then we observe how price flows between those levels and how it reacts at those levels. That tells me something. If price breaks through here and then comes back and then produces two very bullish candles, maybe, so one red one with a tail and then another green one with a tail, it's telling me this is actually really bullish. It tells me that it's probably going to keep going up. So there's that visual, visceral reaction when it gets there. This tells you a lot. It can't get through there. It's battling, and eventually it heads away. And then here it tells you it's staying above that, and then eventually it heads away. And here there's a consolidation at a level, and eventually it heads away. So we get these what we call momentum candles. This is a bit of a price action masterclass, a little bit of a mini masterclass here. So we get these momentum candles when the market makes a move. It doesn't know what to do, and then it makes a move. So you get the market doesn't know what to do, and then it makes a move. All right, over here it doesn't know what to do, and then it makes a move. Even over here, it's not really sure what to do, then it makes a move, but then it makes another move there. We get this. And right now, it's currently in a place where it doesn't really know what to do, and there's clearly a level of resistance here. It's had a move up. It's actually moved and broken out. It needs to potentially, possibly, come back here and take off. So how will that happen? Because we're looking at a weekly chart here. If it's going to happen that way, we would end up seeing a momentum candle. That would be the one that triggers the move, and then we would see it come down to this level and carry on up. Does it have to do that? No. But let's go and measure the Fibonacci on that as well. So let's take our Fibonacci tools, measure from the most recent low up to there, bring it across. And it's interesting because here you can see that the 618 is in this area. But this, remember that our area now is this. That's our area. And it matches up there. And what I find particularly interesting is the alignment of the 50 Fib right across the top here, because those are the previous highs. So yeah, it could do that and end up going to the upside. Could actually just tap that and keep going. I think in this case, for the most part, I think this level or this in this area is more likely than just here, because there's nothing really here. So it usually, it doesn't have to, but I think it's much more likely to do that. Now we are in an uptrend, ladies and gentlemen, we are in an uptrend. So here we went into a trend, then we did a little bit of a consolidation, and now we've got a breakout. So we're still in an uptrend. Could it consolidate along here and then break out? Yeah, it could do that, but there's not an unlimited number of things it can do. It could go sideways and break out. It can come back here and head off, or it could come back here and fall through. That's it. And two of those are bullish and one is bearish. Cool. So let's go back to the slide deck and see how we are doing. You've also potentially heard of the golden ratio. It's really interesting. If you've not heard of the golden ratio, if you're not familiar with Fibonacci in nature, do yourself a favor and YouTube Fibonacci in nature first, because it's about a 2.5-minute video. It just shows you how Fibonacci's measurements and ratios and proportions are built into everything, and it's mind-blowing. And then if you're interested, look at the golden ratios, all these different things that happen. And you know, architects use them when we build houses, certain things that happen. If somebody, we look at somebody's face and something feels off, or in an animated film, if we're watching an animated film where we go, there's something about this character that they look kind of creepy, it's usually because their nose or eyes or whatever have been put in different places that don't match up with the golden ratio that we're so used to seeing. And so we've got these key levels that we can pay attention to. But here's where I really want to kind of talk a little bit more about other tools. So if we go back to this, the two most important things for us will be horizontal levels and price action. So how does Fibonacci come into that? Well, Fibonacci helps us identify price levels. So actually Fibonacci is incredibly powerful, because although we're using it, it's not taking us away from the core stuff. It's not taking us away from support resistance levels and price. It's actually adding to that. It helps us identify support resistance levels that could matter to us. So let's also measure from, again, I can measure from any of these lows. I can measure from this low up to this high and look to see if there's any confluence there. I'll just get rid of this because it's a bit distracting. So you can see we've got a 50 and a 382 in this area here as well. And I'm going to take one more. I'm going to measure from the low here up to the high. What I'm really looking to see is to see if there are any confluences. And I find it interesting. There's one over here. So here we've got a couple that are very close to each other. Excuse me. And then not really anything else that stands out there. Is that important? Is that a problem? No, it's not. It only adds value when we find clusters, because when we find them and they are there, what that often means is that traders on different time frames have identified, without realizing it, have identified the same area, and therefore there might be more orders in that area. So maybe price could come back down to this area and then find a lot of support and head off. That can often happen. So that being said, let's go and let's just play with this a little bit here to measure a few of these things. So if we go up here to measure off this high as well, just to see where that goes, you can see beautifully that it comes back to this level, which is a 50 fib, perfectly. I'm doing this for the first time, so you can see how really beautiful that is. I'm going to measure it up with this one as well. So go up to there, you can see price responding really well to the level there. Then I'm going to do the same thing. I'll sort of come back here, and then I'll move this down to here. So we'll see if anything happens there. And there you can see the same thing, that 382, there's a 50 fib here. So definitely there are clusters here. So in order to make it not so confusing, all we're really doing is we're looking to identify if there are fib levels that overlap with our trend where price could come back to, that could potentially turn out to have orders at that fib traders will be using in that particular case. And so we can do the inverse as well. There's a couple of different things we can do where it gets a little bit tricky, but if you find that price comes back to here, so now we're talking a little bit about fib extensions. If you're finding that price ultimately from where it was here came back down to here and then started to head off, and you managed to get in on a nice little trade here, your entries there, stop losses there, you could potentially target 1618 as your possible target. So what I've done in this particular case is I've flipped around I've just added the numbers into the tool and I've flipped it around. So now it's extending for the move, right? I will say this though, most traders only use the fib retracement tool. Let's put it a different way. It's the most popular. Most traders who use fib tools tend to use the fib retracement tool. It is used the most. Then they might use the fib extension tool as well. And it can be very helpful to help identify a reasonable target on your trade. So I wanted to go and have a look at this when we went to Bitcoin and looked at it in real time. Just want to see what else there is when we talk about this. Okay, that's good. We'll come back to that. So, so let's go through. Let's go down the time frames here so we can see if you said to me, if the market's either trending or not trending. So what's happening with Bitcoin at the moment? Bitcoin is not really trending right now. So it's doing one of two things. It's either battling to break through this level, which means it might fail and go down, or it might break out and keep going. Okay, according to the weekly, it's a bit overextended. If you think of the last move, it was here, then it did the move. It could do with a bit of a correction, but it is cryptos, and we could find that it just takes off. So either could happen. So there's nothing to trade with this right now. We basically need to see it do the next thing. It either has to break out to the upside. It either has to break out to the upside, and then we can get in on buys above that, or it has to break out to the downside. Okay, so how would we use our tools? Well, if we did that and we saw price break out to the downside, for example, and then we saw it start to turn around, and so it's starting to head up, then we would take the Fibonacci measurement tool, and we go from the high down to here, and we'd be looking for it to potentially come back and test itself in any of these areas, and then look for very bearish candles. We're looking for price action to give us bearish signals. So one of the first things you really have to do is to decide, not decide, but to identify, should I be buying or selling in this market? So if it breaks to the upside, I'd be looking for a pullback and I'd be looking to buy. If it breaks to the downside, I'd then be looking for a pullback, then I'd be looking to sell. Does that guarantee that I have all winning trades? No, but most of the time I'll be on the right side of the market. All right, so there's nothing really happening here. That's not the best example here to use. So let's go and let's have a look at some of the other. Let's find a market that's looking interesting. Dollar yen. So let's go down to the 4-hour. Look at this, very interesting. Why is this interesting? Let's measure what's going on here at the moment. So there's a level here. Remember, we want to find out what price levels are important to which market. So we've got a level here that's quite significant. We also, I would say, have a level here that's a little bit significant to the market. I can see a bit of a reaction there, a bit of a reaction there. There's also something else going on here. It's a little bit messy. You can see it there, actually. There we have it, and then it comes across here, and there we are there. So there's a bit of a level there. And then obviously there's a level that's going on down about here. So there's quite a bit going on. Now, are we in an uptrend or a downtrend? Well, we're not sideways. We're not sideways, but I have to explain something here. We were in a downtrend. We were. Goes down, down, down. But now we've come up, we've broken this high here. So when you have a downtrend, and then price comes up and breaks a previous high, this downtrend is not really in place. That's part of the reason we often put our stop loss behind these, because if we come back and break it, it tells us this downtrend is probably done. In addition to that, it's actually done a higher low, so it's done this. So it's done a higher low here. So that's also not a good sign, but we're not in an uptrend yet. An uptrend, we need a low to a high, to a higher low, to a higher high. So we need to break past that to get a brand new trend, because the market is either trending down, no trend, or trending up. And right now it's almost, and it's not guaranteed yet, but it's almost in an uptrend. Okay, so for sure, if we break up through there, we'll be in an uptrend. And so we're looking at these different things here. So also out of curiosity, let's see what's going on. So once it does that, so if the market breaks up through here and then decides to start pulling back, why do I like this? Well, I like it because if it pulls back to here, for example, and it's going to go all the way up here, because that you can see what the different price levels are, I might be able to get a trade out of that, because then I know that it's going to go up, especially if it breaks this high, because then it's looking bullish and I need to get in on that move. And when the market is moving, the worst time when we're untrained, when we're brand new, when we're baby traders, we always are nervous. So we wait for the market to show us where it's going to go. The problem is that's usually once it passes the high and we chase it here. So we get it too late. It's already running away without us and we chase after it. So the second half of the move is the worst time to get in. So here, for example, when price broke through here, this is the second half of the move. It's the worst time to get in. And here's the second half of the move. It's too late. We tend to want to be able to get in actually here if we can. Anywhere in this area is the best. So when the market goes and pulls back, we get in and then we capture this chunk of the move if we can. So that's what I would be looking to do here. I'll be waiting for a pullback and then looking to get an entry as it goes. So in order to do that, I would use the Fibonacci tool, measure from this low to this high. Boom, there's my nice little 50 fib on top of a support resistance level. That area then becomes of very big interest to me. And then I want to see green, strong green candle, nice little green candle that forms in this area, which tells me the buyers are coming in and there's a potential for it to do a move to the upside. So is it guaranteed to come up to here? It's not. It's probably going to go up to there, but it's not guaranteed. So what do? Well, the smart thing to do is if it's on its way up, so if it does come back up here and starts taking off, I want to probably keep an eye on these levels here just to see what's going on and possibly something there. Usually what you would do is you'd aim for this. So if it goes up to that level, that's probably where you're going to close all your positions out, because we're not investing here, guys. We're not investing. We're talking about trading. So a trade is a shorter term, immediate move the market's going to make, and that's it. That's all we're looking to do. So I'm only looking to make a move if it breaks through here up to here. After that, if there's another setup, sure, but you can go broke and lose all your money by not taking profits. So traders always have a plan. When they get in, they go, I'm just looking for the market to go from here to there or from there to there, and then I'm out. Then I've banked the money. Okay, that's one trade down. And then you look for the next, which is why day traders used to have all their trades within a day. So they were only looking for moves that would happen that day, and then they were done. And this is the best mentality to have. Because if you're like, well, I'll look for it today, and then I think Bitcoin's going to go up here. The thing is that Bitcoin could go to 40,000 and 50,000 in a year's time. And between now and then, so you're not wrong about where it's going to go, but it takes a year. And in between now and then, it goes back down to 10,000, and then back up and back down, and you just bleed money all the time. So we know that can happen. We know that it's possible. Therefore, we look for a move, we hit our target, we take the money, and then we see if the trend is still there, because it could change. It could go from here all the way down. So that's what we look to do. And as we go into profit, we take some profit, and then when it gets there, we close out the trade. And then if it reverses and starts going down, we start looking for shorter term sells. So traders are not emotionally invested in where the market has to go. They follow it where it's going, whether it's going up or down. Investors are emotionally and financially and psychologically invested in where the market must go. They have to. It has to go up because they don't make money if it doesn't go up. It's two different mindsets. You can change, you can do both, but you need to know the difference in your mindset. So let's go down. Let's have a look at something else a little bit more fun, a little bit more interesting. Let's go down to that 1 minute. So now we're looking, it's very thin. The market's going to sleep now. It's the time of day. There's not a lot happening. Let's go back up. Let's have a look. Let's go back to euro dollar because it's always very nice and liquid. You can see this is the 1 minute time frame. The market is very sleepy now. There's not a lot happening. You can see it's very choppy and very messy. It has been moving and it's not really doing anything right now. So there's not a lot happening now. Very, very choppy. So that's boring. Sterling, let's have a look. Sterling's moving a little bit. That's not so bad, but it's not very. It's not a lot happening. There's not a lot going on. This is probably the time of day. Let's have a look at the chart here. So let's see what's going on here. Okay, so now we've got a potential level over here, a possible level over there. Let's have a look at that. These are the most recent levels. On the 1 hour, I'm curious if we go down to say the 15 minutes, and again, if I measure the Fibonacci measurements from here up to there, you can see potentially where price can come back to, potentially even over there as well. So different things back to the most recent low. So if you kind of follow what price is doing, you have a low here, then a high, then a low, then the highest point here, then the lowest point there, and then the highest point here. So those are your low points and high points. And so here we can see the 618 is back down here. And this is an example of where that 618 would be a very normal, comes back to test that level, comes back to test it. Maybe it'll do something like this and then go up. You can do that. And so that's what we're looking for price to do. And then we spoke about other indicators. So so far we've got price action, we've got support resistance levels, we've got Fibonacci levels, which provide us extra information on price levels. They're more powerful even when they do also line up with support resistance levels or market structure. It's very powerful. Okay, occasionally they will occur in random places in space, which is fine, but often they tend to occur off market structure as well. So either one is absolutely fine. And so we look for that to happen. So we're looking to see if right now this is getting ready to turn around, and we'll see if that's going to be the case. So again, look at that. On the 5 minute, we can see a bit of a bullish candle setting up here. It's not bad. We could see if that's going to become the setup. Will this ultimately be, the move and that it starts to continue to go up? We'll have to see if that's going to be the case. Again, I think I would prefer a pullback to this level. I think I would prefer to see a pullback to that level. Okay, to my team, can I just ask you guys a quick question? Is everything okay on your side? Anything else you want me to add in? Just to my team to see if everything is all good there. Okay, so what else can we add to this? Well, what about trend lines? So trend lines are very powerful, but most of the time they're not really used the correct way. And again, same thing, MACD, RSI, Williams %R, CCI, stochastics, a lot of these tools can be very powerful, but they're not used the correct way. In the city, when we trade on very large amounts of money, we do not use them in that sense. So I'm going to take you through that very, very quickly. So we'll talk about, think of the indicators, the MACD, the RSI, Williams %R, all of those are momentum indicators. I'm going to show you this. And so the way it works is, often if price is not really doing anything and then it breaks out, it's very bullish, so the angle is very steep. Then it does a small retracement because it's very bullish. Then it does another move, and then it does a small retracement. Then it does not as big a move, and it does a slightly deeper retracement. Now it's starting to run, it's getting tired, it's running out of steam. Then it goes up, then it starts to do a slightly deeper retracement. And what's happening is you can see that it had a nice rest, lots of energy, and now it's starting to get tired. So that's what the price action is doing. That's what your price action is doing. Imagine there's a major support resistance level there. So we can see it's running out of steam. Professional traders are taking their profit, they're getting out, so that it's losing energy as it approaches that level. So what happens with the indicator? So if you're using MACD or RSI, what will happen is the indicator will start like this. It'll be going like this, and I'll just do this to somewhere like this. And then it'll start trending higher, and then it'll start to kind of level out and then potentially start to go down. So what happens here is that as the market starts to lose its momentum, starts to get a little bit tired, the indicator gets left behind. It starts to lag behind. So this is not in the sense that when we use them in the traditional sense of overbought and oversold and moving average crossovers, they are lagging indicators. But when we use it this way, it's actually a leading indicator. We're looking at the same information, but from a different perspective. And it gives us, and then it becomes a very reliable, amazingly reliable, very powerful leading indicator. So also, by the way, we've got about 5 minutes left. So if you have any questions on anything that I've covered so far, please just, now's your chance to type it into the questions box. For example, if you also want to talk about a topic in the next webinar, you want us to do a webinar about a topic that you're very interested in. I'm very keen on doing strategy webinars, and I'm also very keen on doing a masterclass on price action and starting to build strategies and putting everything together, and then also looking at different markets and doing market analysis. That's like all my favorite stuff. So if you want that stuff too, you just need to let the guys know, okay? So here we can see it starts to fall behind, because what's happening is it's measuring this speed compared to this one, and this one compared to this one, and so it starts to fall behind. So what happens here is, although we are making higher highs on price, the indicator's actually started to go bearish. It's actually started to trend lower. And so this going low, we call this divergence. So this is called divergence, and that's divergence. And usually what that's telling us, it's not a signal, it's not a buy or sell signal. It's saying to you, this trend is getting tired. Maybe don't do any more buy opportunities in it. Maybe don't do any more buy trades in it. Maybe just sit it out and wait, because it might change direction. So then what would have to happen is eventually you would see it start to potentially lose its trend. Then it starts to break down, and now it's in a downtrend. And at that point, this has started to go down, and it started to go down. So now what happens is, now you have agreement. So here so on the way up here, it's trending up and it's trending up, it's convergent. Then it gets to this point where it's maybe going up, but it's going down, and there's your divergence. And then the price action then corrects, and now price is going down and the indicator is going down. And so price is back in line with the indicator, and now we have convergence again. So it's only during these little parts where we get that divergence. And so these indicators are incredibly powerful for helping us, because our worst fear is that we find a trend and then we want to get into the trend and the trend loses steam, or it's dying, or we get the last trade on that. We hate that. So we want to perhaps be a little bit more cautious about that. So again, let's go ahead and just look at it on something like this. This is looking very nice. This is looking nice and bearish. If you look at this, it's actually building up to a beautiful, this is a real-time trade setup here. This is a potential trade breakout to the downside. We can see where our usual setups are. That's looking good. I like it. Oh, and if the MACD is bearish, so if I bring up the MACD now, and the MACD is also starting to go bearish, that's a great sign for us. That's also a good sign. Whereas if the MACD is starting to go bullish, this is probably going to fail, and it's going to go up that way. So let's bring on the MACD and see what happens. I'm going to insert indicators, go to my oscillator, bring in my MACD. I don't worry about the, I'm not going to worry about the histogram or the moving average crossover so much. Just going to have a look at this. Let's just see what it looks like. Here we go. So what we can see, we've got a nice little flat line there. We can see that so far it's starting to trend lower. This is good. This is a possibility that we're going to see a break lower. This is a 5 minutes. We might see euro dollar head down. There's a little bit of a level here, but it'll probably come back down to here. So we might see something potentially does something like this maybe and carries on down. It comes back into that level and so on. It looks good. As a possible, this is a potential trade setup. Just move you away. Let's see what happens. It might want to go a little bit, but that is something that I would recommend you look at Just watch for the next 20 minutes. Just watch and see what happens there. So what did I want to show you? I want to show you how the MACD is very, very helpful there. And quickly, let's just go back and have a look at this here. I wanted you to see this. So if you go here very quickly, and then we'll wrap it up, you can see that here we have those higher highs coming up here. And then you can see at the same time, this MACD has started to trend lower. Okay, and then it starts to have a bit of a wobble. And then we get to this point here. Beautifully, it has started to break to the downside and trend lower. And now that it's doing that, the MACD and price are in order. And then here we get the opposite. So here we get a lower low in price, and here we're starting to get a higher low. So there's our potential clue, and then it starts breaking, going to the upside. And while it was doing that, I was talking about trend lines. It starts to break through that downward sloping trend line, and the other way around as well. This way, upward sloping trend line, broke through it. A lot of things I'm throwing at you right now, but that's it. The way that I'm talking here is it's actually using very much simple stuff: support, resistance levels, momentum. What is price action doing? Using fib levels to identify support, resistance levels. And then all I did was throw on the MACD, or it could have been any of the indicators: RSI, Williams percent R, CCI, ATR, stochastics. We could do a separate webinar just on those. And then just to show you how we can identify when a trend is nice and healthy or when it's getting tired. And then also start to look for those entries. So what's happening here? I'm going to wrap this up because we're kind of coming into the end of where we are now, but this is looking potentially bearish. It's a nice little series of lower highs. The sellers on control, flat level there. If we break through that level, we should do a move down. We'll see. So where are we now? Sorry, I hit all the buttons. Ladies and gentlemen, I'm sorry, I wanted to say thank you very much for joining me. I really, really appreciate it. I hope that you found this instructive and useful. And I look forward to seeing you in future webinars. It is recorded, so you may potentially get access to that recording. But again, I look forward to seeing you in future webinars. Thank you very much.